stock market for beginners. This is a quick guide to help you get invested in stocks. It's a non-fluff, non-technical terms, easy way to get into it. But before we dive into it, 3 things. Quick disclaimer, why me, why stocks? The quick disclaimer is that this is not financial advice. Of course, this is education. My name is Beile Grünbaum. I run a fund and I've been teaching people how to invest in stocks for around a decade. Before that, I was a financial journalist. I covered, among others, the financial crisis as a journalist for a newspaper. And before that, I studied at Stern Business School and at Copenhagen Business School. Why stocks? There are plenty of other things you can invest in. Real estate, for example. But real estate requires quite a lot, both physically of you. You have to go out there, visit the property, invest in it, and it can tie up quite a lot of your potential investment capital. It's easier to start investing in stocks. You can do that from your desk, from your kitchen counter. You can do it even from your phone. Cryptos are really risky assets. Bonds are just too slow. Silver, gold, you could physically buy silver or gold. Again, complicated and too slow. So why stocks? Well, if you think about it, it's really quite wonderful that you at your desk at home can become an owner of almost any kind of company in the world. Because that's what happens when you buy stocks. You get a little ownership of a company. Isn't it amazing, really? You can walk around saying, I own Apple, or I own Microsoft, or whatever company that you admire. The great thing is that it's really just a click of a button. It's so easy to become a part owner of a company. And the other great thing is you don't have to do any of the work. You don't have to hire or fire people. You don't have to have board meetings. You don't have to show up 9 a.m. at the office to handle things. Yet you benefit from the profits of this company. Now let's dive into how do you actually do it step by step. First, you need to choose the platform from which you're going to buy the stocks and shares. Now, there are many platforms around the world, and it's a good idea to use one that's local for you because it might be easier tax-wise. For example, in Denmark, where I'm from, you have platforms like Nordnet, Saxo Bank. And when you use these platforms, you don't have to calculate the taxes because they do that for you and send them to the tax authorities and pass them on, so it automatically appears on your tax return. It means you don't have to get an accountant to help you out. You don't have to calculate anything. It is fixed and done. So that's the easiest way. Now, if you are not in Scandinavia, you could use other platforms, and I would Google what's available where you live. I actually do use an American platform as well that I know is also available in the UK, and that's Interactive Brokers. I've been quite happy with that platform. It is possible to invest in stocks from many banks, so I might want to check that out. If it's possible from the bank that you happen to use anyway, if you can invest from that. In some cases, it's a little more expensive to use a normal bank to invest. But you can look up what the differences are. But if you're getting started with investing, just remember this. In the beginning, make it as easy for yourself as possible. Make it simple. So if simple means using your own bank, then stick to that. You can always open another account later. You don't have to have only one account. It's not like buying a house. Like you bought the house, you signed the paper, that's it. I have several accounts, to be quite honest. I have an account with my own bank, which happens to be Nordea. I have an account with Nordnet. I have an account with Saxo Bank, and I have Active Brokers. So those are, quite a few. So let's say Nordea, Nordnet, Saxo Bank, Nordea, Nordnet. Okay, so we'll start. There's so many, I can't even count it, you see? Let's try again. Nordnet, Saxo Bank, and Interactive Brokers. I know I forgot one. Okay, that's it. I have 4. So that's step number 1. It's just choosing which platform you want to use. Step number 2 is actually opening an account with that platform. And it's very easy doesn't take a lot of work. You can do it from home. It might require some kind of identification. Maybe you need to send a picture of your passport. It should be really easy. It might take a day, or it might be instantly that you are approved. In any case, it's not complicated. Step number 3 is that you transfer the money to the account that you have opened. If you're not sure how to do it, you can always ask. You can, first of all, use the hotline of the platform that you have opened an account with, and you can also ask in your own bank. Next up is choosing a strategy. And I'll super quickly tell you about some of the strategies that you can choose. The most popular way of investing is called passive investing. This is where you invest in index funds. Don't freak out. You might be thinking, help, what's index funds? Don't freak out. I'll explain it to you right now. So an index is a collection of stocks. It's just a way to group the stocks. For example, you have Standard & Poor's 500. 500 of the biggest American companies on the US stock exchange. Then you have an index like the FTSE, which are the biggest UK companies. I'm from Denmark. We have OMXC25. You can have an index that covers an industry, a biotech index. What should you choose? And again, don't make it too complicated. Keep it simple. So choose around 3 different funds. Why should you choose an index fund? Well, because an index fund usually has a very low fee. That means it's cheaper for you. And that means more of your money will be invested in the stock market. There are other kinds of funds that will have a particular strategy. So how do you know if it's a passive fund? Passive means, what's the difference between passive and active? Well, a passive fund will match the index. There's not a portfolio manager actively managing the fund, and that means the cost of the fund will be lower. In an active fund, there is a portfolio manager, a guy, and of course, he will need to have a Porsche and a nice house in Hampton and whatever. This guy's job is to pick the stocks in the fund for you. So how do you know if the fund that you are choosing is passive or active? Well, first of all, the index that it is following will be in the name of the fund. Very often, it will even say index in the name. Another way to figure it out is to look up the fund in a database. A database like Morningstar, justetf.com, or etfdb.com. There will be a category that you can choose where you can choose either between active or passive. Now, if you invest in a passive funds, there's a particular way of investing. And this way has a name. It's called dollar cost averaging. What does dollar cost averaging mean? It means that you invest the same amount, for example, every month in the same fund. It could also be every week. The important thing is that it's the same amount at the same time interval. The smart thing about this is that if the market falls, if this price of the fund, the stock price of the fund falls, you will get more shares. And that means that your average price will be lower. And there's a really, really huge advantage to this, because most people will be really scared if stocks fall. But let me show you something. Here you have 2 different stocks, and one goes straight up. It starts at 100. Then the next year it rises to 110, then to 120, then to 130, and then to 140. Nothing moves like that in real life, but I just made it really simple so you can follow me here. The other stock, it starts at 100 as well, then it falls to 60 in year 2, and then in year 3 it stays at 60. Most people would freak out at this point. But in year 4, it goes to 140. This is where the other one ended after 5 years. But it falls again back to 100. So it's back at the same level where we started at 100. Which investment do you think is better? Most people say the first one. But if you invest with dollar cost averaging, it's actually the second one that is better. And why is that? Well, let's look at the numbers. If you invest 1,000, it doesn't matter if it's 1,000 pounds or euros or whatever, kronas, doesn't matter. If you invest 1,000 at 100, you will get 10 shares. And now we're going through the first case, the one that goes straight up. If it goes up to 110, well, then you'll get around 9 shares and so on. So the next year it's 8 shares, and then it's 7 and 7. So at the end, you will have around 42 shares. Well, the other one, the investment that fell, the first year will be exactly the same. You will get 10 shares. You have 1,000, you're buying, and it's costing 100, so you get 10. Then it falls to 60, then you can get 16.7, but that's not possible. And the year after that, it's 16 as well. And then it's going to be 7, because on the 4th year, you can only get 7 because the stock price rose to 140. And the last year, you will get 10. In the end, you will have a little bit less than 60 shares, but let's just say it's 60 to keep it simple. And that means that the value of your investment will be around 6,000. The other one would be just below 6,000. The crazy thing about this example is if the stock price had fallen even more, it would have been a better investment because you would have gotten even more shares. So that's the great thing about dollar cost averaging is if it falls, you will get more, and you just have to stick to the system. The second great thing about dollar cost averaging is that it's a system. You don't think about it. You just keep investing, keep plowing in more money. Now, this method can be refined quite a lot. You can tweak it, and that's one of the things that I teach within my investment course. You can think more like a value investor when you're investing, even when you're investing passively. The other main strategy is called stock picking, and this is where you invest in individual companies. Now, again, there are several ways to do this. Some people are dividend investors, meaning that they go after companies that pay out dividends. And if they pay out a lot in dividends, we call them dividend kings. Now, I do not recommend this strategy because the thing about dividend kings is there are really huge companies that have already reached the max potential in most cases. Because why does a company pay out dividend? Wait, first of all, what is a dividend? A dividend is when a company distributes part of the profit to the shareholders. That money will come into your account as cash. And that's why some people really like it, because they like seeing the cash rolling in. But there's a downside to these dividend kings, and that is they're really huge companies. And the reason they pay out part of the profit is they have nowhere else to place it. Let's take a company like Coca-Cola, for example. They are so huge that every market, they have quite a lot of different soft drinks under their umbrella. So they don't have a lot to invest in. And that's why they pay out a lot of dividends. A company that is growing quite a lot, a company that is earlier in their journey as a company, they will have new markets to enter. They will have new products to invest in. They will have competitors to acquire. So there's a lot of investments to do, and they won't pay out any dividends. So going straight for dividend kings, having that as a strategy is not the best strategy in the world, because you might get the dividend, you probably won't get a great return on your investment. Now, my favorite way of investing in individual companies is called value investing. I do it with a twist, though. Now, what is value investing? Now, that is a big topic, and this is basically what my channel is about. The very, very brief explanation. There are 2 schools within investing. One school believes that the market is efficient, and that is the school that is very happy with investing in index funds. And it is also the school where people seem to be quite happy investing randomly in individual companies. According to this school, the stock market is efficient, and that means that whatever stock price a company has, it is the correct price. They say things like it's already priced into the stock. They see the stock market as a kind of a big machine, and they believe that people think rationally. This school is called the efficient market hypothesis. Now, value investors view the world differently. We do not believe that people are rational beings. And if people are not rational beings, it means that the market is not efficient, at least not most of the time. It means that people get scared and they get greedy. And because people get scared and greedy, stock prices and the market will rise to level where it's no longer realistic. And when the market gets scared or people get scared, the stock prices will fall quite rapidly. And if that is true, if stocks are volatile to a level where they reach irrational high levels and they fall to levels that are just rock bottom and not attached to reality either, that means you can actually invest using that to your advantage. So how do you do that? Well, you need to figure out what a company is worth. And when the stock price falls below that value, then you invest. So you have the value of the company and then you have the stock price. The value of the company will be pretty stable, whereas the stock price will go up and down and up and down. So we keep an eye on the stock price. We calculate the value and then we compare the two and then we invest when there is what we call a margin of safety, meaning that the stock price has fallen below the value of the company. The difference between the stock price and the value is the margin of safety that you have. That's why we talk about the difference between price and value. That's very central to value investing. If you want to learn more about this, I have an ebook below that you can download, and I will actually teach you how to calculate what a company is worth using one of Warren Buffett's methods. So that was point number 4. It's choosing your strategy. So when you've chosen your strategy, you have to choose what specifically you're going to invest in. If you're choosing a fund, you have to research it. You should always research your investments. And of course, if I'm mentioning a company or fund here, that is not investment advice. That is just education. How do you research your investment? Well, for funds, you can use databases like Morningstar or etfdb.com or just etf.com. You can look them up. You can actually click and see which companies are in there, or which, if they're very huge funds like Standard & Poor's 500, you can see the composite of different sectors. That was step number 5. Let's move on to step number 6. Step number 6 is actually buying the shares in either a fund or an individual company. This is where it gets really tricky for many people. And this is where I sometimes get calls from friends that are almost panicking about it. This is where you're actually doing it. And there can be an emotional reaction here. Like, what happens if I push that button? There can also be technical difficulties within the platform. Most platforms, though, are very, very easy to use, but there can be words that are new to you. One very common thing is, what do I choose? When you buy a stock, you can choose how to buy it. So it will usually say market price or limit. Before I explain that, I just want to tell you that every platform and every investing platform have their own videos where they will explain it to you in details. You can just go to YouTube and Google the name of the platform and guide. They will show you how to do it. But anyway, the difference between market and limit, I'll give you a little story. Let's say that you will send a friend to a local flea market. You tell this friend, well, having dinner, I really need a vase. I want a red vase. If you see one, please buy it. And the vase, of course, is the fund or company that you want. Now, you can give him 2 ways to buy it. You can say, I don't care what the vase costs. I just want that red vase today because we're having the dinner today. I want the vase. That's a market price. You will pay whatever the price in the market is. A limit price is where you say, I would like a red vase, but I will only pay 20 euros or dollars or kronas, doesn't matter. Here are 20. Now your friend might go down and the price of the vase is 21. If that's the case, you will not get a vase. And this is where, for many beginners, it seizes them because they said, I put in the order, I didn't get the shares. I don't understand why I didn't get the shares. Well, if you used limit order and you didn't match the price that was traded at the moment, you didn't get it. Sometimes there's a simpler explanation, that is, Well, actually, you put in the order when the market was closed. So you want to check that too. You can only buy shares when the market is open. I sometimes forget that I have to explain things like this. When is the market open? Well, you can Google that. It's different from market to market, but around 9 to 5 for most markets. Let's Google it right now. New York Stock Exchange in opening hours. Googling core trading session 9:30. So 9:30 to 4 for New York Stock Exchange. And Denmark's open from 9 to 5. You can always Google it. If you're not sure if it's a holiday, just Google it. Easy. Now, the next step, and this is really important, keep learning. The person who is making all these decisions is you. You are the person making these investment decisions. So investing in your own knowledge is a really good idea. You will become a better stock market investor if you have more knowledge. Keep learning, read books, follow my YouTube channel, read my ebook, join my investing course. You can read more below. I'll see you in the next video. And just remember, none of this is specific investment advice. It's education, entertainment.